Hello everyone, this is Good Luck Group giving the mini presentation about Part 11 of Project 2 of Financial 5546. All group members are Xun Lu, Sam Zhang, Weichen Kong, and Yusik Zhou. The first problem is what are the null and the alternative hypotheses that the Project 2 is testing? This problem is related to the Part 9. And by comparing the code in Part 9 with the t-status formula, the null hypothesis is that the mean of LS column is equal to 0. That is, the average of the volatility long-short portfolio for each month is equal to 0, which means that there is no difference between the best performed portfolio and the worst performed portfolio among the 5 selected stocks during the given period. In this case, investors could not achieve arbitrage by buying the best performed portfolio and short selling the worst performed portfolio. So, on the contrary, the alternative hypothesis represents that the mean of volatility long-short portfolio for each month is not equal to 0, and the portfolio analysis could help to improve the investment performance based on the 5 selected stocks during the given period. Now let's move to the problem 2. The second problem is about the methodology of the portfolio construction and how is it implemented in Project 2 codebase. This problem is mostly related to the Part 6, the portfolio module. Firstly, the methodology applied in the portfolio construction is quantile return spread analysis, which calculating the spread in returns between the best performed and the worst performed quantiles of a return downside. This is a common analysis in finance and economics, which is primarily used to evaluate the performance of asset portfolios with different risk levels or return distributions. This methodology requires both calculating monthly returns of each stocks and identifying characters of stocks for sorting and quantile dimension. Both of these two requirements have been achieved by ETL module and the characteristics module in this project. The ETL module is for calculating daily and monthly returns of stocks, and the characteristics module is for identifying and calculating selected characters of stocks. After that, the stock's monthly returns data size should be sorted and divided into given number of different quantiles for each month. By subtracting the monthly equated return of the worst performed quantile from that of the best performed quantile, the quantile return differences are calculated, which could be used to evaluate the chance for investors to achieve arbitrage by buying the best performed quantile and selling the worst performed quantile. Now, I'd like to give some explanation about how this methodology implemented in this project. Firstly, in the stock sorting function, stock's monthly return dataset is sorted based on the characteristic from the characteristics module and be divided into Q quantiles. Then, in the portfolio calculation function, equally weighted monthly returns for each quantiles are calculated, and then the quantile return differences between the best performed quantiles and the worst performed quantiles are also calculated, and this is the LS column. Finally, all these functions are called in the portfolio min function to adopt this methodology to portfolio construction. Moreover, In this case, different asides have been seen as equal-weighted, so this methodology could be improved by differently weighting those asides based on, for example, capital asset pricing model and some other active portfolio model such as trainer black model. Next, Lucian will give some detailed analysis about this portfolio construction methodology based on the case example in Part 8.
Our strategy is built upon a foundation of meticulous data analysis. We've utilized daily and monthly stock returns to calculate key characteristics, with a particular focus on total volatility. This metric has guided our portfolio selection process, enabling us to identify potential investment opportunities with a quantifiable approach. In Part 7, we've developed essential tools such as get average and get cumulative return. The get average function allows us to analyze the annual performance of stocks by calculating the average return, excluding any missing values. This provides a clear picture of a stock's average behavior over a year. The get cumulative return function, on the other hand, assesses the long-term growth of our portfolio by computing the product of monthly returns, offering a straightforward view of the portfolio's performance over time. Moving on to Part 8, in 2008, NVDA was notable for having the lowest average daily return, which was negative 0.0042. The result means stock experienced a slight decline in value each day. In 2019, AAPL stood out with the highest average monthly return, an impressive 0.0566. And moving to volatility. Stock V demonstrated a volatility ratio of 2.6 in its average monthly total volatility, which can make it an investment with higher risk and potential for higher rewards. For Tesla in 2010, we calculated an average monthly volatility in 0.0414. This moderate level of volatility reflects the Tesla's market presence and the interest it attracted from the investors during that time. The third question focuses on the output of Part 9. Our long-short portfolio has demonstrated an average daily return of 0.0073, which, when annualized, translates to a substantial gain for investors. This figure, while modest on its own, signifies a reliable and steady performance over time. In the context of hypothesis testing, where we evaluate the non-hypothesis that the average return is zero, and t-value is 1.3847, importantly with more than 200 observations. This t-value exceeds the threshold for significance at the 0.05 level, leading us to reject the non-hypothesis, and the large sample size amplifies the reliability of our statistical analysis, ensuring that our conclusions are not the result of sampling error but a true reflection of the strategy's merit.
Okay, for the questions 5, our group focus on two perspectives in terms of risk management and the data analysis. As I remember in the project 2, the characteristic module already evaluate volatility and manage risk using functions like VOL underlying the CAL functions. However, to further improve the risk management, We suggest that using additional metrics like VAR, CVAR, R squares, and the Sharpe ratio. The VAR helps us understand the worst case scenario under the normal market conditions, and the CVAR goes a step further by considering extreme losses in the tail end of the distributions, helping us manage and mitigate some potential severe losses. And the R square measure how well the portfolio returns align with the market or benchmark, giving insight into how closely our portfolio follows the market trends. Lastly, the Sharpe ratio. The Sharpe ratio compares the performance of different portfolio by factoring in both return and risk, which help us to determine which portfolio offer the best return for different level of risk. In addition to the risk management, our group think that by using the high frequency data and long-term data can improve the project as well. And high frequency data, like intraday data, minute by minute data, it can be more precisely evaluate some market behaviors and market dynamics and some microstructures. Also, long-term return data can be better develop long-term investment strategies within different economic conditions. And the markets tend to be more volatile in the short-term period, but it will smooth out over the long-term investment strategies.